Hi guys, good morning and welcome to Money Control. I'm Karunya Rao and we're here to talk about equity fund SIPs. Now, typically what happens whenever the market peaks, you do remain to be very optimistic about the prospects. You've already, gained a fair amount of money if you have bought in corrections or bought at the right time. But now that the markets have scaled to close to fresh highs, is it a good time perhaps to consider re-evaluating your SIP investments and stop or at least pause them for the time being so that you have that extra cash with you and you can re-enter the markets when there is a dip? So to talk about this, I have my guest joining us today, Lisa Pallavi Barbora. She is a financial coach, a personal finance writer who very often contributes to Money Control as well for the personal finance segment. Lisa, great to have you on board.
Sorry,
Looks
my
like
mic
you're on
wasn't.
mute.
Yeah, I'm there now. Thanks for having me, Karunya. Good to be on the show.
Okay, all right. I want to straight away talk to you about what is happening in the markets right now because typically you tell people to stay invested for the long haul when you invest in SIPs. But now that we have scaled to a certain level, is it a good time to book certain amount of profit and keep some handy cash?
There are a couple of things here. So, first thing is that with equity, we know that it's a long-term kind of investment for most of us individual investors.
Yeah.
When markets are at the peak, the noise levels really increase. And you read it everywhere and you see it everywhere that the market is at a peak and it's high valuation. So what happens is that your SIP, if you were doing a 10,000 rupee SIP, the number of units you could buy at, say, 10% lower levels or 20% lower levels, you can't buy that anymore because the markets have scaled up. And at a peak, you'll be getting lesser units. And there is the expectation that if it is at a peak, that it will start to correct soon. So when that happens, it kind of gets confusing. What should I do? Should I stop my SIP and wait for the market to correct a little? Is this the peak going to be there for just a little bit? Or it's confusing for an individual investor when there's so much noise on the market peak to understand what to do. And fact is, you are buying at expensive levels. So then one needs to kind of take a step back and think about it a little bit. Doesn't mean you stop your SIP, but just kind of be aware, I think, of what's happening.
But right now we're very close to the 52-week high of 62,000 odd. But that hasn't deterred investors yet. They're
Yeah.
still very excited. Is it a good idea to buy at these levels? Because not just SIPs, but even market watchers that we speak to have flagged off about valuation concerns once again.
Yeah, so we know that the latest SIP numbers from Amphi show that I think 13,000 crores in October. That was the number. So that's the highest ever for our industry, where individual investors are trusting their money into the markets. And the whole thing is that so many investors are entering at this level, and this is just SIP, and there could be lump sum as well. So what can you gain in the next year if we just see that the market is correcting? Then are you going to gain anything? Well, fact is that you can't time the markets, and we know this for a long time now. The last 25 odd years or more than that experience shows us that you can't time. You don't know how long the market is going to be at this level valuation wise. You don't know if it will correct, how long the correction will be. So timing that is not a great idea.
Yeah.
One of the things that one could perhaps do is stagger the buying. Meaning, if you're a lump sum investor, then buy a little bit and spread it out over the next 6-9 months. The market may not correct. I mean, if you were in October last year, you'd think that, okay, chalo, let me stagger. But the levels are around the same. So even if you staggered it over the last year, you may or may not have gained much by doing that. But that is the best a lump sum investor can do. An SIP investor is kind of already doing that.
Yeah.
So one might think, what more?
Yeah, yeah. In fact, if we look at similar upcycles of the past, let's say investing at the peak of the dot-com bubble in 2000, global market highs of 2007, that would still have yielded good results if we look at the big picture now in hindsight. Are we looking at something similar right now? Are there any lessons perhaps to learn from such upcycles of sorts when they happen? Is it a good time, especially for those who are starting their journey in the market, in the world of SIP?
Absolutely. I think what you will realize is that whether you start at a peak or at a bottom is not really going to be your choice. From a market cycle perspective, you're not going to, know whether it was peak or bottom or whatever till later. So, but we know that if an investor had started 22 years ago in the peak of 2000, just before the whole tech bubble burst in the equity market, then you and remained invested till date, you could have made close to, I think, 19% return over this period of time on an annualized basis had you remained a regular SIP investor. So, you know, the lesson here is very simple. It is that you need to be a regular investor. It is impossible for us sitting to predict where the level of the market is going to be. And the second thing is that you have to be invested for the long term. See, equity comes with an expectation of inflation plus kind of return. But we
Yeah,
know that equity returns are not linear, right? You will not get like the same return every year. So if you break that cycle and you don't invest in a certain period because you're afraid of what the markets will do, then you're actually breaking, your ability to make that expected return. To make that expected return in equity, you need to remain invested, not break your investment. Give it at least a decade. That's what you need to start with. The other thing that investors can do is perhaps at a market peak, if you're so sort of wired into that the market is going to correct, then keep a little bit of surplus, kind of liquid cash or somewhere where you can withdraw immediately, so that if that correction actually happens, you're already staggering your investment. You also have that kind of dry powder to invest a little bit more in the market if it becomes cheaper from this level. So at
yeah.
market peaks, it may be a good idea to keep that kind of ammunition ready with you. Other than that, just one has to remain invested.
How important is goal setting? Because if you have a short to medium term goal as well, perhaps you should look at the right kind of asset allocation that works for you instead of just blindly investing in equities, right?
Of course, I mean, I think short to medium term goals anyway don't get addressed by equity. But what can happen is, say, you had a 10-year goal for which you were invested in equity, and you're at year 8 today, and
Yeah,
we are at a market peak today. So you are actually 2 years away now. That long term goal has really become kind of like a short term goal, and you are at a market peak. So I think in that case, it's a great idea to maybe book your profits. You've had 8 years of nice compounding, and in 2 years, we know the market can go anywhere. It can be as volatile as you have seen ever. So may not be great to leave that money in. Take out what you need for that goal and leave the rest, but that's how one can plan. So if you have something coming up for which you had a long term investment, but maximum period is gone and you have a little bit more, then at market peaks it's tricky to remain invested, so one has to kind of think that through.
right. And you said it's nearly impossible to time the market, which most of us, I'm sure, agree with. But can you time your time in the market? Because we get a lot of questions or often about how much is the ideal time to stay invested if investing in equity fund SIPs. So, is there like a time frame that one should ideally commit themselves to?
So, so we keep saying long term, but what we have found through historical data and kind of breaking that down is that in a 7-8 year period, the chances of making a negative return from equity are close to zero. So
Oh,
I think that's your minimum. threshold of investment, and the longer the better. Again, going back to the 2000 peak, had you started in the 2000 peak and remained invested till, say, 2008 peak, so that's, 8 years, you would have made about 12, 13% annualized return. Had you remained invested for another 12 years, you would have made 19% return. So the longer the better, but at least 7, 8 years is what data shows us from an Indian equity market perspective. Again, this is very relative to what we are talking about in India and a growing economy, all those conditions in place. What we have found through data is that it takes at least that much time.
Okay, but investing at the peak of markets vis-a-vis investing between these up cycles and at a time when markets are more steady and stable, is there a difference in approach or a difference in how you should sort of set your goals and set your commitments?
I don't know. I mean, one could, but see, again, I'll go back to 2000. So had one invested, the markets really fell for a good 2, 3 year period. And the bottom came, I think, somewhere in 2001. If you'd invested in that bottom
Hmm.
and you'd invested, say, till the market came back to the 2000 peak, you could have, in a period of, I think, 2 years and 2 months, you could have made about 1.6 times your money. Now, that's a great investment, right? Had you timed it perfectly, gotten in the bottom, you could have really gained a lot in just a period of 2 years, 160%. But I'll tell you, it's not just about the numbers. Because if you're an equity investor, you'll know that just 2 years ago in March 2020, when the markets crashed, they did correct, I think, close to 50%. And that's a great correction to enter. But did anyone have the courage? There was so much pessimism. We were in the middle of this uncertainty surrounding the pandemic. Who would have wanted to put all your investment into equity at that time? But the fact is, in hindsight, had you done that, you would have made a lot of return. So it's not just about trying to time your goals, etc., around the markets. Your goals will always remain your goals. um, you just have to plan it so that anything which is 5 years plus goal gets addressed through equities. Anything which is short to medium term does not get into the volatility that equities provide, and it's some other mode of fixed income or any other kind of investment that is better suited. So I think that basic has to be there. It's again impossible to know what the market will do today or tomorrow or even a year later.
Right. As closing comments, Lisa, anything else or any other tips or measures that you want to share with our viewers so that they can optimize on their SIP investments?
So I think one way to really like get a kick in terms of your return is to not keep your SIP static. So if you are doing, say, 10,000 rupee SIP or 20,000 or 50,000, whatever the number is in this year, then try that and that's a regular investment, but try also to regularize your kind of SIP kick ups. So in the next year, increase your SIP amount by, whatever you're comfortable with, 10%. So if you're investing 50,000 in SIP this year, then at least 55,000 next year. That is really going to now kick in not just the compounding, but also how wealth is created over the long term. So that is one of the things that investors can do. You may think you're investing well, but as your income increases, also try to kind of keep increasing that amount a little bit.
Okay, great. I hope our viewers have taken note of that. And on that note, Lisa, thank you so much for joining us and for taking us through the historic trends and even the current trend that's panning out as far as equity fund SIPs are concerned, and how our viewers and retail investors can maximize and optimize their investments in SIPs. With that, it's a wrap. Thank you for watching.
Thank you, Karanya. Thanks for having me. Thanks a lot.